Good evening. Please come to IAS 8. Now today's topic is change in accounting estimate. Change in accounting estimate. So first we will see what do you mean by estimates. Estimates are the approximation of the amount. Till we get the accurate information, we have to make the estimate. There are so many areas in accounts where estimates are required. For example, provisions. The simplest and the best example is provision. Provision for gratuity is an estimate only. Provision for warranty expense is an estimate. Provision for taxation is also an estimate. Allowance for bad debt is an estimate. Useful life of a property, plant, equipment item, estimate. Residual value of a property, plant, equipment are estimate. So does our standards allow us to make estimates? The answer is yes. Otherwise, how will you close the books of account? How will you prepare the statement of financial position and statement of profit and loss? We cannot keep waiting for the accurate information, and therefore you can make estimate. So this standard will guide you how to make estimate and what will you do if there are changes in accounting estimates. Estimates are essential for presentation of the financial statement. When financial information cannot be measured accurately, so you have to make the estimate. These accounting estimates require making certain judgment based on the available and reliable information. So while making the estimate, you may have to make some judgment and you have to make some use of whatever information is available. Like for example, if you buy a machine, the one judgment that we need to make is what will be the useful life of that asset. In case if we have an existing machine, or if the industry to which we belong has been using a similar machine and there is an information about the useful life, that can be taken as a base. If you are making provision for warranty, then in that case we have some past experience, past information that can be used as a basis for making estimate about the warranty provision. There may be a change in judgment which will require change in the accounting estimate, because estimates are based on judgment, and therefore if the judgment changes, the estimate would change. The nature of the estimates are such that they are most likely to change only. So estimates can't be accurate. If estimates were accurate, then it is not an estimate. Is it right? So estimates are bound to change. Some of the examples where estimates are required are bad debt provision, then the obsolescence of inventory, the fair value of financial asset and liabilities, even that require estimate, because their valuation is based on present value of future cash flow, and future is uncertain. Okay. Then the useful life of, or the expected pattern of consumption of future economic benefit embodied in the depreciable asset, and for example warranty obligation. These are not complete list. This is not a complete list. This is only a list of examples given in this standard. Now in this box that I have provided to you, it's a summary of what you are going to do in case of change in accounting estimate, summarized in simple statements. First, very important in this chapter, if there is a change in estimate, the effect will be given prospectively in the profit or loss from the period of change. If there is a change in accounting policy, voluntary adoption of accounting policy retrospectively. If there is a error discovered in the current year, then the effect will be prospectively. But if there is a change in retrospectively, but if there is a change in accounting estimate, the effect is prospective. That means from the period of change. You don't have to dig the past books here. You don't have to make any adjustment in the opening balances. Okay, you don't have to prepare the third financial position statement. Okay, if the change affect the items of asset, liability and equity, the carrying amount will be adjusted in the period of change. The nature and amount of change in an accounting estimate. Nature means what is the nature of change, and amount that has an effect in the current period or that is also expected to have an impact in the future period is required to be disclosed. Some change in estimate may affect only the current period. Example, change in bad debt provision. Some may affect current and future period. For example, change in the useful life will not only affect the current year depreciation, will also affect depreciation of the future period also. The entity shall state the fact if it is impracticable to estimate the impact on future period. Wherever possible, you have to give the effect of the change in estimate. If it affects current period, give the effect. If it affects current and future period, give the effect. And if it is impracticable to estimate the impact on the future period, then that fact will be disclosed. So management will say it is impracticable to estimate the impact on the future period. A change in accounting estimate, underline, does not relate to a prior period nor it is an error. So the institute can give you question and they will say, is it a prior period item or is it a change in estimate? Actual warranty cost was 2 lakh, warranty provision was 3 lakh. Is it a change in estimate or is it a prior period error? Warranty provision, I am asking you a question, was 3 lakh, but actual warranty expense is 2 lakh only. Change in estimate, actual bad debt is 2 lakh. Allowance for bad debt made in the books 2,50,000. Is it an error or a change in estimate? Change in estimate. A change in the measurement basis applied is a change in accounting policy. A change in measurement basis applied is a change in accounting policy and is not a change in accounting estimate. So example, right, FIFO to weighted average is a change in accounting policy. FIFO to weighted average is a change in AP, accounting policy. But then the student will ask, what if it is change in method of depreciation from WDV to SLM? That is a change in estimate. IAS 16 specifically talks about that it is a change in estimate. Okay. So change in method of depreciation, it's a way of calculating depreciation, way of estimating the depreciation, how the asset is getting depreciated. Now will be called as a change in accounting estimate. Maybe some years ago you might have learned that it is a change in accounting policy. Okay, but now it is henceforth change from cost method to revaluation method. Cost to revaluation model. Is it a change in accounting policy or change in estimate? It's a change in accounting policy, because choosing whether an asset should be shown at cost is your accounting policy. It's a basis of showing that asset in the financial statement. So under IAS 16, an asset which was earlier valued at cost, now they want to follow revaluation model, will be called a change in accounting policy. But this is not given retrospective effect because of specific requirement of IAS 16. Okay. When it is difficult to distinguish a change in accounting policy from a change in an accounting estimate, the change is treated as a change in an accounting estimate. The change is treated as a change in accounting estimate. So if you are changing many things at a time, Some portion of it may be due to change in accounting policy, some may be change in estimate. So at a time what you are doing, from a single asset, now you are using component approach. Then you are following cost model. Now you are moving to revaluation model. You are changing the useful life also simultaneously. You are changing the method of depreciation also simultaneously. Everything you are changing in one go. So some portion of it would be change in policy, some portion of it will be change in estimate, but then it is very difficult to identify what portion will go to policy and what portion will go to estimate. So in such cases you are given one relaxation, you treat it as a change in accounting estimate. We have solved one problem number 3 also, which had this issue, and this entire thing we had done prospective application. So the advantage of this is that you can do the prospective application. Is it right? You don't have to do the retrospective application. Now some QA session will start. An entity procures a second-hand machine and determines the depreciation charge based on the expected life of the machine. However, at a future period, the entity realizes that the estimated life of the machine does not match the original estimate. As a result, there is a change in the rate of depreciation from 10% to 12% required. Can this change in depreciation rate qualify for retrospective restatement? Qualify, FY, correction. Can this change in the rate of depreciation qualify for retrospective restatement? Why not? Useful life they have revised. Changing the rate of depreciation means useful life has been revised. Change in useful life is a change in accounting estimate, and therefore change in accounting estimate as per IAS 8 will be given prospective effect. So how do you present the answer? The change to the rate of depreciation cannot be carried out retrospectively, since the circumstances and information available at the time of original estimation are different from the information and circumstances on the date of the change in the estimation, right? Now that was change in estimate. Try this one. The original cost of the equipment is $115,000 and an estimated useful life of 10 years with a nil residual value. It is depreciated on straight line basis annually. That comes to $11,500 per annum. The carrying amount of the equipment after 3 years will be $80,500. It was decided in the 4th year that the remaining useful life of the equipment is only 3 years. The remaining life is only 3 years and not 7 years. Required state the accounting treatment of the asset in the books. So what is the remaining useful life now? 3 years. And what is the carrying amount of this equipment now? 80,500. Does it have a residual value? So what you will do, whatever is the balance left now, divide by 3 years. So now the depreciation that you are going to charge in current year and the next 2 years would be 8,500 divided by 3, $26,833. So you have to write in the notes that due to change in the estimate of the useful life, depreciation per annum will revise from 11,500 per annum to 26,833 per annum. So therefore in future also the depreciation charge would go up. Okay. So depreciation would be charged in that year and in the next 2 years by bringing forward the carrying amount divided by the revised remaining useful life. that is 80,500 by 3 is 26,833. The depreciation charge for the past 3 years should not be changed. This is called prospective implication. Now the third part of this wonderful chapter is called errors. Error we have seen, it is the omission or misstatement in one or more prior years. Okay. And now the question is, this error was discovered in the current financial year. How to give the effect of the error in the current financial year? So error may pertain to, what are the possible error? It may pertain to a recognition issue. A capital expenditure is recognized as revenue expenditure. It may relate to a measurement issue. 10% of 10,000, 1 lakh. Measurement. It may relate to presentation issue. Okay, maybe instead of non-current item, you have shown it as current item, or it may relate to disclosure of financial statement. So errors include, I think this we discussed earlier also. Why do errors happen? Failure to use reliable and available information when the financial statements are authorized for issue. So this shows the laziness on the part of the accountant or the management. Available information was there, reliable information was there, but he will not use it properly. Mathematical mistake, simple calculation error, mistakes in applying accounting policy, oversight, you forgot to write something, record certain thing, or misinterpretation of facts. Misinterpretation of fact. Revenue expenditure was wrongly interpreted as capital expenditure. And even the frauds will be treated as error. See one example of error. Question number 6 in your note. Sunshine Enterprise prepares its financial statement by recording a purchase of a CNC machine during 20x5 worth rupees 50,000 under purchases instead of purchase of non-current asset, and the error comes to light in the following accounting year. What they have purchased? CNC machine. Where have they recorded this? Under purchase instead of a non-current asset, purchase of capital good. So the question is, discuss whether the change would warrant a prior period adjustment, whether this is a prior period error, whether IAS 8 is applicable, yes or no. Is there any error in this? The answer is yes. It's a capital expenditure, should have been capitalized and depreciation should have been charged. Instead of that, they have treated the entire amount as revenue expenditure. Considering the nature of the transaction and the value of the transaction, it is a material transaction. Therefore, this is a prior period error. One more chance. Question number 7. Rose International is preparing its financial statement as at 31st December 20x5 due to a change in the estimated life of the machinery. The company auditors decide to change the rate of depreciation from 10 to 15%. Discuss whether the change would warrant a prior period adjustment. Is it a prior period adjustment? Change in the estimated life of the machinery is a change in accounting estimate. This is not a prior period adjustment. This transaction does not qualify for a prior period adjustment because the change in the rate of depreciation is not a correction of error or a change in accounting policy. The determination of the rate of depreciation is based on estimate. One more chance. 8th question. Jupiter Limited is preparing its financial statement for 2016. Management wishes to change the valuation of inventory from FIFO to weighted average. Discuss whether the change would warrant a prior period adjustment. Yes, no. Changing from FIFO to weighted average is a change in the measurement basis of inventory. It is not a prior period item. It is change in accounting policy. Okay. Errors pertaining to prior periods. Accounting for correction of errors now. Paragraph 14. How to deal with correction of errors. Errors pertaining to prior periods are made good by restating the comparative information for prior period presented if it relates to that period, or by restating the asset, liability and equity for the earliest prior period presented. Now suppose our financial year is 2020-21, current year, I will write CY, and the previous year comparative is 2019-20. Is it right? If the error is committed in this year, then do you need to prepare one more set of statement of financial position? No. You are going to make a rectification in this year only. So error pertaining to prior period. So first you understand it relates to just immediate previous year, are made good by restating the comparative information. So go to this year, make the correction. It will automatically affect your statement of profit and loss, SOFP, SOCIE, whatever, if it relates to that period. But suppose the error was committed in 2018-19 or before, then in that case I have to prepare one more SOFP, which will be that 1/4/2019, and give the effect of all these error, prior period errors, by adjusting the opening balance on 1/4/19. Because this will change, this will also change, because this balance will become opening balance, so your closing balance will change, this will also change. Is it right? If it relates to that comparative year, or by restating the asset, liability and equity for the earliest prior period presented. So we'll have to restate the opening balance of asset, liability, equity of 1/4/2019. Now suppose the error was committed in 2002 and now we are in 2021. Then the problem of practicality and impracticality will also arise. So first you look at this chart, it says practicable. Accounting for correction of error from retrospective effect is practicable. Then give retrospective restatement. Is it right? But if it is impracticable, one may be period specific and then cumulative effect. In both cases, what you do, you try to go as far as possible and make the adjustment. Is it right? So you will suppose error was committed 10 years ago, but you can't go to 10 years. You can go to only 2 years. Then go to as earliest period as possible for which the retrospective restatement is possible. Is it right? So periodic specific retrospective restatement of opening balance from the earliest period for which it is practicable, and cumulative effect, again restatement of comparative information prospectively from the earliest date practicable. So what is the cumulative effect of that error? We have to revise the opening balance, but in case if you are not able to go to the original date, then as earlier date practicable as possible. What if it is not possible at all? Earliest date is not practicable at all. Then the last choice is you have to give the effect in the current year only, prospectively. Is it right? If earliest date is not practicable, then only you will adjust from the current year. But normally 1 or 2 year is practicable. Is it right? You have that much information with you. So this is about the treatment of correction of error. Retrospective restatement wherever practicable, and if it is not practical, then from the earliest date practicable. And as we have seen in IAS 1, in case of retrospective restatement, one more SOFP will be presented at the beginning of the earliest date presented. So 3 SOFP will be given. What about the disclosure? With respect to prior period errors, you have to disclose nature of prior period error. So you will say the management had committed a fraud which was discovered in this year. Then effect on each line item for the prior period presented and the basic and diluted EPS. So if this will affect the basic and diluted EPS, that also you have to disclose. Okay, by how much the basic and diluted EPS will be affected, disclose. An amount of correction at the beginning of the earliest prior period presented, that will be disclosed separately. And in case of impracticability, the fact of impracticability of retrospective restatement. Is it right? These are the disclosure requirement. Now first we'll solve one question number 9. This will give you an idea how to do the retrospective restatement. So such case studies are possible in the exam for anything from 5 to 10 marks. During 20X2, Beta Limited discovered that some product that had been sold during 20X1, means previous year only. So you have to rectify previous year. Because of that, the opening balance will change, and the current year that had been sold during 20X1 were incorrectly included in inventory at March 31, 20X1 at rupees 6,500. So what has happened? First to understand, inventory has been sold in this previous year, but were incorrectly included in inventory of this year, that is previous year. So what will happen? Your closing stock figure of previous year is wrong, so opening stock is wrong. Previous year cost of goods sold is wrong. Previous year gross profit is wrong. Previous year net profit is wrong. Previous year closing retained earning figure is wrong. This year opening retained earning figure is wrong. Is it right? So we have to go to this year, that is 20X1, and make a correction, and then the effect of that correction will be carried forward to this year. Beta's accounting record for 20X2 shows sales of 1,04,000, cost of goods sold of 86,500, including rupees 6,500 for error in the opening inventory. This inventory does not exist only. Why it does not exist? It was sold in the last year, but it is included in the opening stock of this year. Is it right? So don't you think your current year cost of goods sold is overstated by 6,500, and last year cost of goods sold is understated by 6,500? Is it right? And income tax of 5,250. In 20X1, Beta Limited had reported sales 73,500, cost of goods sold 53,500, profit before income tax 20,000, income tax 6,000, profit of rupees 14,000. In 20X1, opening retained earning was rupees 20,000 last year. Opening balance will not change of last year, and closing retained earning was 34. This will change. Beta's income tax rate is 30%, For 20x2 and 20x1, it had no other income or expense. Beta Limited had rupees 5,000 of share capital throughout and no other component of equity except for retained earning. Its shares are not publicly traded and it does not disclose earning per share. Good. Then what are we supposed to do? We are supposed to explain how this error will be corrected. Is it right? So first you understand the statement of profit and loss. This is current year. This is previous year restated. Sales will be same, 1,04,000. Audit, tick mark, 73,500. What will change? This second line will change. What was the cost of goods sold they had considered in the earlier year? 86,500. But 86,500, current year, includes opening stock also, which does not exist. It has been sold. So this figure 86,500 minus 6,500. And how much cost of goods sold they had recorded in the last year? 53,500. 53,500 plus 6,500. If you record cost of goods sold, if you record in cost of goods sold closing stock which does not exist, closing stock figure will go down. Formula for cost of goods sold is opening stock plus purchase minus closing stock. Higher the closing stock, lower the cost of goods sold. So last year cost of goods sold is understated. This year overstated. Rectified. So you got profit before tax 24,000 and 13,500. Income tax rate is 30%. 7,200, 4,050. And therefore the profit will be 16,800 and 9,450. Now we'll see the revised statement of changes in equity. Okay. This is the last year. First check the last year. First few lines and then current year. So we'll start from the opening balance on 31st March 20x0. 5,000 is given. Share capital is not changing at all. And opening retained earning of previous year is 20,000. Total is 25,000. Now this is the change. You will put this figure now. 9,450. From where this 9,450 has come? Revised profit. 9,450. And therefore the balance on 31st March 20x1 will be 5,000, 29,450 and 34,450. And current year profit will again be revised. What is the current year profit after giving the effect of this correction of error? 16,800. 16,800. And therefore now the correct balance will be 5,000 share capital and 46,250. And then you have to write a note also. What is the note we are going to write? Some products that had been sold in 2000-2001 were incorrectly included in the inventory on 31st March 20x1 at rupees 6,500. The financial statement on March 31, 20x1 have been restated to correct this error. The effect of the restatement on those financial statement is as summarized above. There is no effect in March 31, 20x2. Okay. Come to previous page. Sixth component of financial statement. Paragraph 16. This is already covered in IAS 1 also. Whenever there is a retrospective application of accounting policy and retrospective restatement of prior period errors, an additional element of financial statement in the form of statement of financial position as at the beginning of the earliest comparative period is required to be presented. Is it right? So that is called sixth component of financial statement. Why it is called sixth component? Which are the first five component? SOFP, statement of profit and loss and other comprehensive income, statement of cash flow, notes, and statement of changes in equity. And this sixth component means that additional SOFP that has to be presented. Now the last paragraph for discussion. What are the major changes in the Indian accounting standard and IAS 8? So first keep in mind there is no major change at all. Okay. Only one small change is there which a plain reading you will not be able to notice also, is about that guidance, mandatory guidance. Okay. Other than that there is no serious difference. Usual differences will continue in all the standard. For example, there it is mentioned balance sheet, here it is mentioned SOFP. So that will be there in all the statement. I am not writing it again and again at the end of every chapter now. But the other difference is para 9 of IAS 8 provide that IFRS are accompanied by guidance to assist entities in applying their requirements. Guidance that is an integral part of IFRS is mandatory. Guidance that is not an integral part of IFRS does not contain requirement for financial statement. In Ind AS 8, para 9 has been modified, underline. So this is the small change, but it is not called carve out because it's a very minor change. Paragraph 9 has been modified by not including the text given in the context of guidance forming non-integral part of the Ind AS. As such, guidance has not been given in the Ind AS. Ind AS does not have non-integral part, guidance note which is non-integral part. There is nothing like that. Whatever is there is Ind AS contains that. So that's a minor difference. You can ignore it also. So therefore, you can use this chapter for Ind AS. You can use this chapter for IFRS. Yes. This chapter is over.